Corporate finance practice problem using OneNote. Debenture that is callable price calculation. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, down in the 1617 Debenture that is callable price calculation tab. Also note, when using OneNote, look at the immersive reader tool. Our presentations up top will be in the text areas as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, information's up top, doing the calculations on down below. We're going to be calculating the price of a bond. This time, however, new component, that being the bond is callable. What will be the consequences of it being callable? And we'll also have it be semi-annual, which will be a little bit different, a little bit more complex than the annual payments on the bonds. However, note that if you just want to look at the normal calculation of the price of the bond, take a look at the prior section where we do a lot more examples there and we do them spending more time on that calculation. Here we're focused on the new thing, which is the callable component. Also note that if you want to work on the present value calculations, take a look at a prior section where we do the present value calculations in multiple formats, including tables and including Excel as well as formulas. So we have the debentures here. The face amount of the debenture, $1,000. Coupon rate is the 12%. Yield to maturity, or market rate, in other words, 7%. Due in years of 20 years, and currently collectible at 1,300. So it could be, currently callable at the 1,300. So the callable components, the new component at the 1,300, they are semi-annual in nature. So we're going to do the same kind of calculation we would with regards to like a bond situation, and then we'll take into consideration this callable component and see what the consequence of that would be. So the bond calculation will be much the same here, and that's going to be that we need to take the present value of the annuity payments, which are going to be the semi-annual payments, which are the 1,000 times the rate on the bond, 1.12, and that will be equal to the 120 if it were for a year, but there's 6-month time period, so we'll divide that then by 2, and that'll give us our $60 for the 20-year time period, or 6-month periods of 40 periods. Then we'll also need to take the present value of the 1,000 at the end of the 20 years as well. So that calculation then on down below, this is our standard price calculation for a type of bond, type of asset or security. So we got the present value of interest. This is going to be the formula in Excel. It's a little bit more complicated due to the fact that it's semi-annual, but not too complex. We would be taking the rate. The rate would be the market rate, which in this case is the 7%, but the 7% is per year. And remember, whenever you see a percent, unless given otherwise, it usually means per year. If you have some other time period you're going to apply to it, such as 6 months or half a year, then you got to account for that. So we'll divide it by 2, and then we'll take the number of periods. The number of periods would be 20, but that would be if they're yearly periods, and we're talking about 6-month periods. So we got to double those because there's twice as many 6-month periods or half a year periods. So we'll take that 20 times 2, and then we have the payment. The payment would be the 1,000 times the 12%, the rate on the bond, but that would be for an entire year. So we have 6-month time periods that these will be paid. So we'll take that and divide it by 2. That would give us the 1,000 at 281.30. Then we'd have the present value of the principal. Present value of the principal is going to be that 1,000 that we're going to carry back to the current time period using the market rate of the 7%. Would look like this. The rate would be, once again, 7%. That's the market rate or the yield to maturity, but that's for the entire year, and we're looking at 6-month time periods, so we will take that divided by 2, comma, number of periods would be, once again, 20, but that would be for a yearly period. We need 6-month or half-year periods, so we're going to multiply that times 2 for 40 periods, comma, comma. Future value then would be the 1,000 face amount, pulling that back to get the 252.57. Adding that together gives us the price of the 1,533.88. Note, of course, that the yield here being less than the coupon rate on the bond, resulting in a premium, the bond price being higher, in other words, than the face amount of the bond. Then we take into consideration the current callability of the bond, at the 1,300. What's that going to do? Well, it's unlikely then if we're saying that we calculate the price to be the 1,533.88, it's probably the case that it's in market terms, it's going to be basically capped at the 1,300 or about that area, because the risk of it being called, if it could be called at the 1,300, would limit, you would think, it going much beyond that level. That would be, in essence, what would happen with the callable component with regards to the market. So a call price will keep the bonds from getting much over that price, meaning the 1,300. Investors will not generally buy the bonds at the market price when there's a risk they will be called away at the lower price. So in other words, they're likely to say, hey, I'm not going to pay the 1,533.88 like I might if there were no callable option, due to the fact that it could be called back at the 1,300. So you would think then, in general, the 1,003 or the callable component would act as a kind of cap in terms of the market conditions and what the market might be willing to pay for a particular bond or security.